Well, good morning, everyone, and thank you, Melissa, for that very, very nice introduction. As she mentioned, Joel Katz, his father and my father started an accounting firm after the war, probably in about 48, and they were accountants themselves for decades and decades, which reminds me when I was a young boy, I should say, I said to my father, you know, what do you think I should do? Should I become an accountant like you are? And he said to me, well, Stu, let me give you the facts of life here. I think you lack the charismatic personality that it takes to become an accountant. But I was pretty good with numbers, so I decided to become an economist instead. And the difference is, nothing that I say ever really has to add up. So it really for me was a much, much better choice. For you, you do have net worth and bottom lines. We, an economist, especially in the fog of a government shutdown, just kind of get to make up the numbers as we go along. So this morning, I'm going to go through this PowerPoint. Glad to be here. Such a large crowd. You got a very busy day. I noticed the theme, Mr. Rogers, so it's perfect. The land of make-believe, and that's what economics is all about. You know, the trolley goes up, the trolley goes down, and as a result, the economy goes up and down with it as well. So we're going to talk about the economy. Of course, the government shutdown is over. So all kinds of economic data that we get from the federal government, or would have gotten in the past couple, well, now it was almost a month and a half, we haven't gotten. So I'm going to try to, even Chairman Powell, Fed Chair Powell, talked about the fog of doing economic policy, Fed policy, and for those of us in the markets and trying to analyze the economy, the national economy, yeah, it has definitely been somewhat of a blind spot. Now, probably over the next couple of weeks, the government will start announcing some economic data, but just yesterday, the White House said they're probably never going to be able to formally announce the job data for the month of October, because nobody was there to do the surveys, and maybe the CPI data. So the two most important data to the Fed, who has a dual mandate, keep inflation down 2%. By the way, I don't know if you've heard economists speak, but there are three types of economists. There are those who can count and those who can't. Those are the three different types of economists that are in the profession. So in any event, the Fed does have a mandate to keep inflation down. 2% is their target. I'll show you some charts. And to keep the unemployment rate down. Now, they don't have an official target on that, but something in the area of where it is now. The national number, at least as of August, the last data we have, was 4.3%. Historically, if you go back 60, 70, 80 years, that's on the relatively low side. It was even a little lower last year. So the Fed is sitting here, and they're above their inflation target, which is closer to 3%, and the unemployment rate is probably going to move up. And so they're going to be in conflict, and we'll get to that. But not having economic data, at least federal government data, certainly complicates their job. And that's why in the last 6, 8 weeks, economists have been, turning over all kinds of stones, and not just economists, market people, people in your profession trying to guide your clients that, can depend on national economic trends as they affect southwestern Pennsylvania or other areas. And we'll say maybe a few words at the end about southwestern PA, and then as as Melissa said, time for Q&A at the end. So, we're going to get a deluge of data over the next couple of weeks. We're waiting for the BLS, the Bureau of Labor Statistics, that controls most of that data to probably put out a release schedule. But apparently some data was never collected. So we're going to do something I don't think we didn't do in the other shutdowns that we've had in decades gone by. We're actually going to be have to skip between what we knew in September or August and maybe what the government will be able to tell us for the months of November, and we'll have to do a bridge over October. But that's the kind of environment that we're in. And as I say, fits well with the Mr. Rogers neighborhood. So here's the outlook. This is GDP, the most comprehensive measure of the U.S. economy. It's about $29 trillion, in case you have a little perspective there. This is the growth rate and adjusted for inflation quarter by quarter. And as I say, 29 trillion, largest by far. China's around 18 trillion. If you added up the 26 European Union economies, their collective GDP is about 18 trillion. So while the US, certainly our GDP has shrunk as a share of the world's economy, as China's grown and other nations have grown, we're still by far the largest economy by over $10 trillion compared to China. So what happens in the US certainly matters to the rest of the world. We may no longer be the atlas of the world economy and everything was resting on our shoulders, but still, things that happen in the US clearly reverberate not only, of course, to our North American neighbors, but to Europe and to Asia, and likewise, of course, what happens in China and in Europe reverberate around the world. So what I'm showing you there, I think we got that. The 3.8, let me see, yeah. 3.8 was the actual data for the summer quarter, second quarter. That's why it's dark blue. The line there is, anything to the right of the line is our forecast. So last quarter, the third quarter, normally we would know the number. And I'd be able to say to you, here's what GDP did in the third quarter. But of course, that number didn't come out because it would have normally have been released during the shutdown. So our estimate was around 3.2%, which is still a pretty good quarter. And by the way, a lot of that growth was led by consumers. So there's a lot of discussion. I don't know, maybe you've heard about the K economy. The K economy, letter K, sort of the upper leg of the K is the top 1/3 of American families, either by wealth or by income. And the bottom K is kind of like the bottom 2/3. And things are doing pretty well for the top third and not so well, although I don't think it's actually going down. But it's talking about the bifurcated economy that we see so much of, which has only gotten worse in terms of the, let's say, discrepancy or differential between wealthier Americans who typically own a home, who more likely would own stock, and therefore have benefited from the stock market's rise and have benefited from wage growth, and the lower end that is much more dependent on renters and much more and in fields where their pay is not as great and where you're seeing delinquencies rise. I think it was just noted that card delinquencies for subprime borrowers, meaning the ones with the lowest credit scores, delinquency rates have risen to almost or maybe about as high as they've ever been. So we do have somewhat of a bifurcated economy, or it's really bifurcated means two, but it's really maybe the 1/3 at the top, the 2/3 at the bottom. So our forecast going forward, as you can see, this quarter, remember the government shut down for almost half the quarter. I mean, here we are on November 13th, almost half the quarter, but the most important half, the holiday season, some of the most important couple of 6-8 weeks that we have in the year is immediately ahead of us. So we have economic growth slowing down to about 1%. The shutdown probably knocked that down, maybe 0.5%. Some of that will be recouped. The government workers are getting paid. That was part of the deal. Obviously, the ACA subsidies are yet to be discussed, but all government employees that were laid off during the shutdown that weren't paid, yesterday I went through the airport and I said thank you to TSA people because they've been working there without any pay. Now they're going to get paid. At one point, President Trump was talking about not paying back pay to civilian federal employees. So they're going to get paid. The government's going to reopen. Obviously, the SNAP benefits and other subsidies that were delayed are going to get paid in full. And the deal was there'll be a discussion, a vote on the Obamacare or ACA subsidies. So that's why a lot of people on the Democratic side are very angry because they didn't get a guarantee. They got, well, we're going to put it to a vote, at least in the House. but will it pass? And then what we'll do in the Senate. So that whole issue of health care and the premiums and how much they're going to go up or have gone up, is still very much up in the air, which is what a lot of Democrats wanted to get resolved, which is why you have heard a lot of, infighting in the Democratic Party and a lot of criticism of the 8 senators, Democrat senators that did agree, including our own Senator Fetterman. But I'm not going to dwell on politics. What you can see as you look out through 2026, and that's the 4 quarters of 2026, is you see moderate growth in our projection of around 1.5 to 1.75%. That is below the long run average. Of course, by the way, if you look at the very beginning of that chart, you see that big down and up, that's the pandemic. That was the spring or the second quarter of 2020 and the third quarter of 2020. The economy fell off a cliff, but as we did get some vaccines and people went back to work and some cures or at least treatments for COVID, the economy rebounded, and it's pretty much grown every quarter since, with one exception, and that was in the quarter where Russia invaded Ukraine. And in the first quarter of this year, as everyone was sort of getting ready for the tariffs, as the president talked about tariffs, and then of course on April 2nd, announced those reciprocal tariffs, the market collapsed. And a week later, he said, never mind, or let's rethink some of that. And that was the right thing to do, because I think if we had left those tariffs, which would have probably been somewhere around 25% across the world, from around 2% that they'd been in recent years. It wasn't like they were zero, but the average was 2.5%, 3%. So I would have taken them from 3 to 25. That's when economists were starting to say, I think there's a recession ahead. That's when the stock market, forget economists, when it was down almost 20% and falling limit every day in that first week of April after the announcement. And then the president put the 90-day pause on. And then since then, it's been somewhat piecemeal. And of course, as I said in my earlier title, I think this recent truce with China, after the rare earths that they were going to restrict, and the president said, I'm going to add 100%. And then Xi and President Trump met and, made nice. And I guess the fortune cookie opened up and said, you are going to get along. We're not going to put rare earth tariffs on, and you're not going to put 100 extra %, and we'll talk about it in the future. And the markets, breathed kind of a sigh of relief. And now that the government shutdown is over, the government's breathed a sigh of relief. But the picture I want you to take away is we're not in the recession camp. All that, talk about the K economy and talk about the weakness and the AI bubble, perhaps. We don't think the economy is going into recession. Now, clearly, economic policies can change, and we'll see what happens. And if this holiday season coming up doesn't turn out to be decent, we'll be wrong. First time for everything. I've been at PNC 45 years. I've never been wrong yet. So you may be, you noticed, Melissa also said, she pointed out that I have been recognized as one of the least inaccurate economic forecasters, meaning I got something right, which put me ahead of every other economist who's never got a damn thing right. So maybe this time I'll be right, maybe I'll be wrong. But our forecast is below trend, moderate economic growth, a number of speed bumps in terms of inflation, in terms of the tariff policy, in terms of this somewhat bifurcation. But we think the economy is going to grow. And that is a positive, at least cautiously optimistic, part of the outlook for the economy. Now, some would say that an optimistic economist is an oxymoron. And some have said, no, you're just a plain moron. But in any event, we're staying in the economy will grow camp, but it won't be able to grow as rapidly as it did the last couple of years. And the job growth, which has already slowed down a lot, and some of that has to do with immigration policies and the lack of immigrants coming in, and of course the deportations, A lot of the slowdown in job growth that we've seen, really the first quarter looked all right, but since about May and then particularly over the summer months, but remember, we only got data through August, and we're probably not going to get the October data. We think we'll get September on jobs, the job report that comes out the first Friday of every month. So maybe next week they'll tell us that September we expect some slow, modest job growth, less than 50,000. A good month would be 100, 150. And that's what we've been doing, and well beyond that in the last couple of years. If we don't get a number for October, and then we'll get November. But I think I've always said, you can't take 1 month's number and put too much weight on it. This is, as I say, a $29 trillion economy. We have 160 million people working. So the government does a survey. They do their best. I don't think it's politically biased, although that issue has come up when President Trump fired the head of the Bureau of Labor Statistics and was going to put in somebody, he was going to put in he was going to put in somebody who was the chief economist for the Heritage Foundation. And when people actually had a chance to look at this individual, and the Congress realized that fortunately, that they're not going to confirm him, nor should they have. So the BLS is still without a head. They got an acting head. The president still has to appoint someone. So in the midst of all this government shutdown, overlaying it there was some concern on their accuracy of the numbers. And I'll readily admit the economic data is a shadow of what's happening. It's not as precise as accounting, as I was kidding at the beginning. And so to take any 1 month's data on inflation or economic growth or job growth, there's a large margin of error, not political bias. I want to make a big distinction between somebody politically, putting their thumb to make it look better or worse because of political. No, they're just natural measurement error when you're trying to measure the economy this large. So I always have said, let's take a 3 or 6 month moving average. Even in your numbers, when you have a company and they have a bad month. But does that mean the company's going out of business? Or does that mean, there was something going on? And if you look over the quarter, things look better. And if you look over the year, so you got to have a little perspective over time, because obviously anything can happen for 1 month or even 1 quarter, like this quarter. Half the government shut down for half of it. So if we don't get data for October, that's not good, but we'll take the average of sort of maybe the August number, the September number, the November number, and we'll kind of average it and do a little interpolation on the missing data to see what's the underlying trend. And it is absolutely clear that job growth has slowed dramatically since about the first quarter of this year. And I'll show you some numbers on that in a minute. And the unemployment rate has ticked up a little bit. And in our forecast, that's consistent with pretty minimal job growth. Probably less than 1 million people in a year, maybe even 500,000. And that's pretty slow. In the last couple of years, we've been adding 3 million jobs. And the economy's done well. It was initially overstated, but even with the revisions, it was about 2 million. So we think we're going to do less than half of that, maybe a third of that, and the unemployment rate is going to rise from 4.3 in our forecast over the course of the next year, probably not to 5%, but probably to closer to 4 3/4. That's still low historically, but when you're moving from below 4 last year to the low 4% this year, up to the high 4%, that's an economy that isn't doing as well. That's why economic growth isn't going to be as strong as the last couple of years. And frankly, it'll exacerbate some of that K, duality or bifurcation, because a lot of that job growth will slow down, or lack thereof, will be people in, lower income brackets. The other thing that's going on is with the immigration policy, at least data through August, the number of foreign-born people working was down 1.5 million this year. The American-born was up about 2.5, or about 2 million. So the net was still an increase. So clearly, immigration policies, either less people coming in, more people being deported, and a number of people who are afraid to show up at work, you've seen another bifurcation. American-born workers are still growing. Foreign-born immigrants, they could be citizens, they could be legal, undocumented, whatever you want to call. That's what's happening over the last 6 months, at least through August, that we have data. All right, here is a real pretty chart. You don't see very colorful charts. This is my homage to Sheldon Cooper's Fun with Flags. Okay, so 7 flags at the top represent 7 developed economies, as they're called. The 4 at the bottom represent 4 developing, although China being in the developing economy is sort of a misnomer from days gone by, or EM, as EM stands emerging market or developing. DM means developed economies. Well, there are lots of numbers there. I know you're used to numbers. The thing is, as you look, this is not my forecast. This is the International Monetary Fund. They just met last month. If you look at 2025 and 2026, the numbers are positive. Again, the IMF is not forecasting a global downturn. In the developed markets and in the, quote, developing. Now, China's numbers I take with 2 grains of salt, because they announced the number, I think they announced on January 1st what the economy was going to grow. Their forecast of the economy in 2025, they announced on January 1st, 2025. So in other words, I'm kidding. They announced on the first day of the year, here's what we think the economy is going to grow. And I can assure you, that's what the economy is going to grow. Or at least that's what they're going to announce on January 1st, 2026, that, man, we hit it right on the nose. The economy grew 4.5% to 5%. So that's what we worry about in the US a little bit, about the integrity of economic data. We've always been viewed as being the gold standard of economic data. Not that it's always accurate, not that, you can measure an economy this large, but again, it's not politically biased. It's not like the president calls over to the BLS. So that's why some of this firing the BLS had the markets pretty nervous, but it's kind of gone to the side because the data's not coming out anyway. So we'll see when the data starts to come out and who the president points to the BLS, if the markets start to question not just the accuracy, but the validity of the data, and that it's not politically biased to make it look better because the administration wants it to. Hopefully we don't get there. That would be the equivalent of you're cooking the books, none that you would ever do that. But I think there have been some accountants down through the years at some companies that have somehow cooked the books. We hope that the federal government does not get into the chef business of cooking books on economic data. But the point there is the global economy is likely to grow, has grown this year, and is likely to grow, but again, at a more tepid pace. The one exception is India. India has been doing extremely well, and they're expected to continue to do very well. Brazil, you never know. I'm just looking at some of the developing markets. But India sort of is a standout of the smaller economies that are growing. As I say, China, take with a grain of salt. Europe has not been growing as fast as the US. Canada and Mexico are North American neighbors. Mexico's, quote, a developing market. Clearly, we'll have to see what happens with the tariffs and supposedly a renegotiation of the USMCA, the US-Mexico-Canada agreement that is likely to occur next year. But anyway, the US is growing. We think the world will grow. But if you compare these to sort of long-run trends, in terms of economic growth, they would all be below average. If you look at inflation, it is higher. Inflation is a bit higher this year. We think the tariffs are being passed through. Not dramatically, not as much as I feared, or we might have feared back on April 2nd when we thought the tariff rate might be 25%. As best we can calculate based on the tariff duties, they call them customs duties, that the government has been collecting, that they announced, at least, and even through October, that data came through from the Treasury. they're collecting about $32 billion. They, the government, we, are collecting $32 billion a month in the months of September and October from tariffs. Before that, back, say, at the beginning of the year, it was about $7 billion a month, because there were tariffs. But it's increased by about $25 billion. If you take $32 billion and divide it by the goods imports of the US, very broad measure, it's about 11%. So the average tariff rate, based on our knowledge of what we're importing, goods, because there are very few services, although there are some that have tariff, most of it are goods. Divide 32 by whatever the number is, 400 and something, or 300 and something, it's about 11%. So that's the average tariff rate. And of course, that's added a lot to the Treasury coffers. Although I would note that went on, it was building up. The budget deficit in the year ended September 30, the fiscal year, despite some of those increased tariffs, was still $1.8 trillion. It was no better than it was the year before. Now, maybe it would have gotten better, but the one big, beautiful bill does have some tax cuts in there, and of course maintains, as you well know, the tax levels, I won't call them cuts, the levels that were in the, what was it, 2018 bill. So it's estimated that could add, had that not been extended, that could add $300 to $500 billion a year to the budget deficit in and of itself. Maybe partly offset from tariffs, although you heard President Trump say he's thinking of sending everybody a $2,000 check, which is what he called a tariff rebate. I don't know the details of that. Obviously, nobody in this room is going to get it because you make too much damn money to qualify. But most, people that bottom K would get a check. Is that going to happen? How many people? How many billions of dollars is that? And obviously, then that'll add to the deficit because those numbers are not coming from increased taxes. Well, anyway, tariffs is a tax. The word tariff, by the way, is about 350 years old. And I'll bore you to death for one more second. By the way, you do know that PNC's tagline is brilliantly born. And you know which half I represent. So just keep that. I was the model for that half of the tagline. I've been there for 45 years. In any event, as I say, the rebates, who knows? Tariff came from there was a city in Italy called Tarifa. and all the trade that used to go on in the 15s and 16s and 1700s, a lot of stuff came through there. And when they came through, they took a little piece, the city of Tarifa. In other words, they taxed all the trade that was going on between Italy and Spain and you name it. Hence, 400 or 500 years later, the word tariff comes from a town, happened to be called Tarifa. If it had been called taxo, we would actually call it for what it is. It's a tax on the American people, although so far, clearly it has been split between buyers and some of the importers and some of the producers. We think there'll be more inflation, both in the US and I'll show you in a minute, as more of these tariffs are passed through. Here's the dollar. The dollar may be important to some of your clients if they do business internationally. The dollar sharply fell in the first half of the year, dropped by about 10%. Pretty much that's the kind of the trade-weighted dollar. But, against the euro, against the pound, against the Canadian dollar, again, it was worth less at mid-year than it was at the beginning. Since then, that blue part, that orange part is sort of what's happened last quarter. So it's just floated around. It's kind of leveled off. It's bottomed out. We think the dollar is still going to get a little bit weaker for a lot of reasons, including Fed rate cuts and including the continued tariffs and the slower economic growth. So I don't know how relevant that is to many of your businesses, but to the extent they do import or export, we think that the dollar situation it'll get a little bit further weaker. Maybe the yen might be the exception against most of the major, euro, C dollar, not so much the yuan, in China, but Australian, India, rupee, et cetera, et cetera. I'm going to pick up the pace a little here. So this is the unemployment rate. That top line is the unemployment rate. I don't show you job growth, but as I mentioned, it slowed down. It's 4.3, that's August data, that's the last official data. This gives you a little bit of breakdown by different, in this case, black, Hispanic, white. Black unemployment rate has actually moved up a little more. White unemployment rate is about as low as it ever gets, and Hispanic is pretty low as well. But as I say, you can see, of course, the 15% is where we got in the early days of the pandemic. That's how it was estimated. It was probably really 25, but though everyone was sent home, so it was who knows what number it really was. But it's been coming down and has trended up a little. Our forecast, well, I don't show it on there. I don't show you the forecast bars, but if I did, that last number is August. Probably in October and November when we get the data, if we don't get it for October, it'll creep up to maybe 4.4. We think by this time next year, as we get to the end of 2026, as I mentioned, it'll be 4 3/4, maybe 5%. That isn't recessionary, but that clearly is a movement in the wrong direction. It's part of the reason, as we said, with economic growth slowing down and with the whole immigration issue and deportation issue, that's affecting both the supply of workers and the demand is going down, and everything in economics is supply and demand, and where they kind of intersect, we think, is an unemployment rate that moves up as job growth is much slower next year than even this year, and this year less than the year before and the year before that. I got a couple of charts here. I know you folks are used to numbers. This is one we've looked at. This doesn't come from the government. This comes from the Institute of Supply Management. It's a private organization. It has member companies. Every month, it surveys their companies, asking them, how's business? But I mean, it's more specific, like how are your sales, what's prices, how are your orders, what are your shipments? There's a whole battery of questions. And they average that up, weighted average, and come up with a number. If it's below 50, that shows the net is declining. So 50 is the break even, not zero, just the way it's constructed. This is for manufacturing firms. Manufacturing accounts for about 20% of US GDP. Of course, decades ago, it accounted for 30 or 40. It accounts for 12% of jobs. So it accounts for a much bigger share of GDP than jobs because of the productivity, let alone what might come with AI. But if you notice, most of those numbers are just below 50. So by this measure, manufacturing has sort of been in a flat period. And we're seeing that. Other than aerospace, because it was just a year ago that Boeing was on strike, they came off. Boeing's flush with orders, and Boeing and aerospace is doing well. Autos have recovered somewhat, but the rest of manufacturing is pretty flat. So how do you get economic growth if manufacturing is kind of flat and not adding jobs? Where do you get the growth from? Well, next chart. Same Institute of Supply Management, same survey, only now they're surveying non-manufacturing companies, part of their group. So this is accountants and economists and banks and healthcare and IT and, of course, technology and retail trade and construction. This is the other 80% of the economy that isn't a manufacturer: hotels, travel, tourism. That's 80% of the economy. If you notice, those numbers are above 50. They're close to 50, but they're in expansion territory. And they have been, and that's where our growth is coming from. It's the non-manufacturing part of the economy. Energy's in there a little bit as well. Here in southwestern Pennsylvania, obviously we haven't fared as well because our Marcellus Shale is not throwing off the kind of jobs as it did, over a decade ago. But for the whole economy, we're producing a record amount of oil, and that's reflected in some of these numbers. This is the travel, the tourism, of course, the technology, the education, the healthcare. That's where our growth is going to come from. That's where it's come from. We think that's where it's going to be. But since it's kind of like, 80%, we're firing on kind of 4 out of 5 cylinders. The manufacturing cylinder is sort of not firing. And that's why we don't think we can get overall economic growth back to or above trend, or as good as it was the last couple of years when even these numbers for services were a lot higher, mostly services, than they were before. I'm going to give you 3 quick numbers on housing. This is home starts. If any of you have builders or construction and all these are national numbers. I'll try to say a word at the end about southwestern PA. But you can see, basically housing starts have been flatlined. That doesn't mean zero, it just means they've been around about 1.3 million new home starts a year for the last 3 years. That's below trend. And it has added nothing to economic growth. I mean, certainly there have been jobs and, it's kind of going forward. But housing has not been adding to economic growth over the last 3 years. Next chart is the sales of homes. The blue line is existing homes. Now, it looks funny there. There's a different, your numbers, guys. So there's a different scale. If you look on the left scale, that's the scale for existing home sales. Over 4 million of them. The right scale is brand newly built homes, around 700,000 lately. So clearly we sell almost 6 times as many existing homes as newly built homes, and you kind of don't get that by looking at a chart where it looks like the 2 lines are just on top of each other. But whatever you look at, those numbers are flat for 3 years. We really haven't seen any increase or much decrease, ups and downs, seasons. And so existing home sales have really not added much. A lot of people didn't want to sell their homes because they were locked in on a low mortgage, so they didn't want to sell. And a lot of people, this whole affordability crisis that you could say was very much the watchword of the election last week, and probably the election a year ago when Trump talked about how unaffordable everything was and the Biden inflation, and it helped get him elected. Well, the same issue still exists. Inflation is still too high. It's above the Fed target. And homes are still relatively unaffordable, and mortgage rates have come down a little. And then here's home prices to complete the trio. This is year-over-year change. Again, a private sector number comes from Case-Shiller. That's why we have data through September. These are year-over-year. You can see in the post-pandemic, everybody could live wherever they wanted. When you called in on and your boss said, "Where are you?" I hear wild bird sounds and ocean breezes behind you. And you said, "Oh, that's on my phone." And when I gave talks back then, I looked like this, only I didn't have any pants on. So, and you didn't have skirts or pants on either, and you were sitting at your desk, and maybe a couple of times you might have inadvertently had a gender reveal, but for the most part, you were seen from here up. And home prices skyrocketed. Then it slowed down to where it was basically, not that they're falling, but they stopped rising. But really, and that was the summer of '03. Home prices are rising, but they're slowing down again. And we do think the price appreciation, as more existing home sales are finally coming on the market, and the level of prices is so high that we're likely to see modest appreciation in home prices going forward, sort of in line with the overall inflation rate of around 2.5% to 3%, not, as you can see, 5, 6, and of course during the heady days of 20%. But cumulative, if you did a sign and said, well, what's the cumulative increase of that kind of year by year or year over year increase, home prices are up 40%. From what they were just prior to the pandemic, which is what, almost 6 years ago. So that means they're up almost 8% a year, compounded. And that's why they're so difficult. And that was part of the theme of free rent in New York and free buses and, rent stabilization. I don't believe in any of that because you can't just stop demand and you're going to screw up supply, but we won't go into that, any of it. Okay, that's a measure of supply disruptions away from normal, kind of when it's zero. You can see how crazy it got during the pandemic and post-pandemic when you couldn't ship anything across And even if you got it here, you couldn't get it unloaded from the dock. And even if you got it unloaded, you couldn't get it on a train or a truck. So the whole supply chain was screwed up. It was very inflationary. And we know what happened to inflation a couple of years ago. But the good news is that despite the tariffs, it's kind of back to normal. If you need something from Europe, you can get it shipped. It won't be like, well, fine. The orders today, you'll see it in a year. You might see it in a couple months or a couple weeks, whatever, quote, used to be relatively normal. That's good news from an inflation point of view, or we say anti-inflation. Now let's get into a couple last charts and then we'll have a little time for Q&A. Here's our forecast for interest rates. The green line is the rate the Fed controls, called the federal funds rate. The orange line is the 30-year fixed mortgage rate. The blue line is the 10-year Treasury rate. Everything to the left of the vertical is actual data. Everything to the right is fearless forecast. And you can see up there it says PNC forecast. We think the Fed is going to cut rates a couple more times. There's a real debate whether they're going to do it in December. They meet on December 10th. We still have a quarter-point rate cut penciled in, but given some of recent Fed talk, given this data fog that is going to clear up a little, but they may be missing very important pieces now of the October inflation and job data, it's only 3 weeks away. They meet on December 10th. So the Fed might pause. I mean, if you asked me a couple of weeks ago, I'd have said pretty good odds they're going to cut. If you ask me today, I'd have to say a little flip of a coin, but since we have to make a call, I'd say they're going to cut. But if I'm wrong, I still don't think it means they're done cutting rates. They cut them twice in the last 2 months. Maybe they'll take a pause, but given what we said about the economy and jobs being below trend and the downside risks, I think the Fed's got a few more rate cuts. If not in December, then maybe in January or March. If you notice, beyond that, that green line goes flat. It goes flat for 2 reasons. One, because we don't think the economics will justify any more rate cuts because rates will be down almost 200 points from where they were. But another little major caveat. In May, Fed Chair Powell's term expires as chair. It's a 4-year term. It's not like the Supreme Court. You're not appointed for life. Why they would take useless lawyers and put them in a position for life and take really useful, productive economists and only give them a 4-year term is just because there were more lawyers in the Congress than there were economists, or they would have realized the relative importance of economists relative to lawyers. But unfortunately, we're stuck with that as history. Who's the president going to appoint? The president appoints the new chair. He actually appointed Powell 8 years ago. Then Biden reappointed him. I don't think he's going to reappoint him. I'd say the betting odds in that are somewhere between nil and none, if you want to put money on it. And who's he going to pick? Well, supposedly there's 4 names on the short list. One is Governor Waller, who's on the board now, who I would feel pretty comfortable with. The other is Governor Mickey Bowman. She's on the board now. I would feel fairly comfortable. But there are a couple other names that the market, forget what I would feel. The market would worry a bit that this Fed chair would be doing more the bidding of the president rather than the independent analysis that the Fed's been doing for 113 years. A little bit of what some people feel about the Supreme Court. It's stacked in the president's favor. So we'll have to see. So trying to predict what the Fed's going to do beyond May with a new Fed chair, a couple new governors, which also, the way the Fed's structured is there's 7 governors, they're in D.C., and there's 12 Reserve Bank presidents. In fact, this afternoon when I leave here, and that was part of the reason Melissa was nice enough to move me up, is today at 11:30, the Economic Club of Pittsburgh, that's our kind of a group here, is hosting the president of the Federal Reserve Bank of Cleveland, Beth Hammack, who's just been appointed a couple of months ago, is going to speak to our club. So I'm actually going to leave here and hear about how stupid I was this morning from the president of the Federal Reserve Bank of Cleveland, our district, that's Western Pennsylvania and Ohio, and she's coming to speak to our group. So there are 12 Reserve Bank presidents, 7 governors. This was set up, by the way, and the Fed was set up in 1913. So it's been around for 112 years. And so we'll see. The President of the United States appoints the governors, subject to Senate confirmation. The presidents are picked by their own board of directors, but presumably with some okay by the board of governors, but the president ostensibly, the political process has nothing to do with it. We'll see how that holds and who's going to be chair in May. And as I say, the markets will make a judgment. If they really think they got somebody in there who's going to keep lowering rates because the president wants him to or her, the markets probably aren't going to like that. They're going to worry about the inflationary consequences. So we'll let the markets decide. But that's kind of why we think the Fed will be cutting rates for the right economic reasons over the next couple of months, if not in December, then maybe January, March, and then we'll see what happens. This is the inflation rate. The blue and orange line is the rate of inflation, year over year. It's not the CPI, it's kind of the fraternal twin. It's called the personal consumption expenditure deflator. Say that 3 times. It's the fraternal twin of the CPI. It is derived from the CPI, same DNA, but there are little differences. They're not identical. But you can see how high those numbers got. The blue line is with energy and food. The orange line is what we call core. The reason we do that is sometimes food and energy is a lot more volatile. Part of that big jump that you see was right after the Russian invasion of Ukraine. Oil prices got to $130 a barrel. Gasoline got to $5 a gallon. 3 years ago, we were looking at $5 a gallon gasoline. Today, it's closer to $3 a gallon. And wheat and other commodities were affected, and food prices skyrocketed. And it's been coming down. But again, this is the rate of change. This isn't level. Do again a sine wave. If you say what happened to the level of prices since, say, around the pandemic, they're up around 25% on average. In fact, I'll come back to it. There's the consumer price index. That's the one that's a little better known, but as they say, they're so close. If you look, all items, like 60, 70,000 things that get priced in there, this is since February of 2020. So we're almost 6 years. I picked right, or actually January, before the pandemic. We're up, prices on average are up 25%. Over what, 6 years? You're pretty good math, that's about 4% a year. So it's not the 8 or 9%, but 4% for 6 straight years is a lot of inflation. And you can see, of course, egg prices have gone up the most, and believe it or not, medical care has gone up less, but new vehicle, you can go through. And again, this is only just recently, this data was through September, that's the latest inflation data we have, and of course, only partly reflects tariffs. But if you want one picture of why people worry about affordability, it's the cumulative increase in the consumer price index, which is basically the measure of inflation in the last almost, say, 5.5 years. And if you notice also, wages and salaries, the ECI stands, wages and salaries, 23%. So prices have gone up 25%, people's wages have gone up 23%. In other words, we've been running on a treadmill and if anything, fallen a little behind, on average. Some of the K economy, and particularly the people on the lower half of the K, probably didn't even do that well. The people in the upper half of the K, upper leg, did much better than that because this doesn't account for what the stock market's done. And I already showed you what house prices have done in the last 6 years, up 60%. So if you own a home and you own stocks and your wages pretty much kept up with inflation, doesn't feel that bad. But that's probably about 1 out of 3 of us, not necessarily in this room. Last chart. Well, next to the last. This is the University of Michigan. They have a consumer sentiment survey. They used to have a good football team, but as you heard, I'm a graduate from Penn State, so I'm not talking lately about football. I will bite my tongue. This is a measure the University of Michigan's been doing for 60 years. I don't go back that far. The black line is the measure of average consumer expectations about the economy. The green line is people who say, I'm a Republican. The blue line is people who say, I'm a Democrat. The orange line is people who say, I'm an independent. And the black line is the average of all three. According to Republicans, since Donald Trump was elected, the economy is doing great. You can see their confidence is not as good as during his first term. And the red line is, red and blue shadings are Republicans and Democrats, red being Republican. So during the Trump years, of course, Republicans always thought the economy felt better and Democrats not. But the average was a lot higher than it is today. In fact, this number, where this Michigan is recessionary. If this were truly the way people were acting and not just feeling, we'd be in recession. Consumer spending would be in the dumps. This holiday would be a bust. Every time the measure has been that low, and I'm talking the black line because that's the average, you would have a terrible holiday. So this isn't, I'm not even using this anymore. This is really a Rorschach test. You show a picture of the economy, if you're a Republican, man, that looks like a great big elephant. If you're a Democrat, it looks like a great big donkey. And so the perceptions of the economy are totally skewed or clouded or whatever, distorted. And the reality is, though, when you take it on average, it's still pretty low. But consumer spending has been very good. So this is a case of watch what people do, not what they say. And they tell people, I make the joke, they tell people how bad they are, how terrible the economy is, and the survey calls them up, and then the person says, I'd like to talk to you longer, but I can't because I got to go pick up my new car, I got to pick up my kids from school, and I got to pack for the cruise that I'm going on. But the economy sucks. And that's what's going on. And if you're Democrat, it's really bad, just as Republicans said it was all during the Biden years. So don't pay too much attention. It's more of a political test. Final comment there is, this is the stock market. I'll say one word at the end here about PNC's view on the market. Record high, coming down the last week or two. AI, is there an AI bubble? The market's gotten hit. Oracle's down 30%. Nvidia's down. Tesla's off a little. The Mag 7 stocks have gotten hit. And some of the value stocks, even like a PNC or banks, have done a little better. Do we think that's the end of the rally? That the market is in a bubble and, it's going to head down from here? No. For the next couple of weeks, next couple of days, maybe. Although usually there's a pretty good seasonal tendency for a kind of year-end rally. But we think the market's going higher next year. Maybe it'll broaden out. And it won't all be 7 stocks that now account for over 30% of the S&P 500. So 7 stocks are over, I think it's 33%. 493 stocks account for 67%. That's very lopsided or very concentrated. So certainly when the big stocks, the names you all recognize, have a bad week, the S&P doesn't do that well. Although there was some offset from some of the other 493 stocks. We think we're going to see 7,000. I talk about the S&P more than the Dow. We think it'll go above 7. We think there'll be a lot of ups and downs. The world economy, stocks are doing much lately for the first time in years. Europe and other stocks have outperformed the US. We're not convinced that's going to last. Some of that is helped by the dollar that I had up there earlier. But we actually think, next year, relative to interest rates coming down, that stocks will more than keep up with inflation. And of course, there'll be bad periods where they'll go down 10%, which is more normal than not. But we're telling clients if the market sells off, do some buying. And keep a balanced portfolio. Don't put everything in the S&P, or don't put everything in the 7 stocks in the S&P. But our discussion with our wealth manager or private bank clients is still, keep the faith, so to speak. This year the market's up big. Last year the market's up big. We're not talking about 20%. We've had an extraordinary period of time, the last 4 or 5 years, where the market has had a string of very big increases. And it does make you nervous, and when you see the concentration. So maybe next year the market's up 5%. That would be, in the 72, 7,300. But we don't think it's going to be down 5 or down 10. And we don't think the economy and earnings are going to roll over, and therefore there'll be some support even for an expensive market that's trading at close to 22 times earnings. Still an expensive market, but we think that there's upside room, and if we do have a sell-off, whether it's in the next 3 weeks or in the next 3 months, our view would be, if we're right about the economy, we're right about the Fed, we're right that inflation will go up but then start to come down as some of those tariff pass-throughs end, and then in the latter half of next year, inflation will be looking better, that will be a positive outlook for the equity markets, and therefore, even though they're expensive, you want to remain invested in the market in a balanced, diversified way. You also want to own some bonds, but that's our, kind of view on how the equity market and the fixed income market could fare in this broader economic context. If I said anything about southwestern Pennsylvania, it would be that we're growing, but we're lagging. Our jobs are back at a record compared to, say, the beginning of 2020, before the pandemic. The U.S. passed that years ago. It's only recently that that Southwestern PA has caught up or gotten back the jobs that it lost in the worst of the pandemic. So it took us 5 years, took the U.S. 3. Our unemployment rate is low, but because we keep losing people. I hate to say it, but that was true in Pennsylvania. In the last 5 years, we've lost residents of the Commonwealth. And much of that loss, or a good part of it, is southwestern Pennsylvania. So we're losing residents. So part of the reason our unemployment rate is around 4% is not because our job growth's been great. It's because a lot of our people have been going south. The lucky ones went to Florida. The less lucky ones went 6 feet, but they went south. And they are no longer amongst the living or the residents of Pittsburgh. So we still have our work cut out for it. Now the governor's put money in. I mean, we would be a great place for a data center with all the Marcellus Shale and the relatively cheap and available energy, although I haven't heard anybody talking about that. Clearly, we're seeing investments. We got the draft. In 6 months, we're going to have 500,000 people, coming into Pittsburgh, spending all kinds of money. That's great. Short boost. Our tourism is doing well. We have fewer manufacturing jobs. We have fewer construction jobs, and we have fewer energy jobs now than we did, let's say at the end of 6 years ago, 2019, the end of 2019, right before just before the worst of the pandemic. Total jobs are about the same. Obviously, that's all healthcare, technology, service sector, not manufacturing, not construction, not energy. So we have our work cut out for us here in southwestern Pennsylvania. We are growing. If the national economy grows and has kind of a decent year next year, southwestern Pennsylvania will kind of come along for the ride, but we're the caboose. Unfortunately, we've been the caboose, or damn near close to it, of the economic train over the last 5 or 6 years. But at least we're attached to the engine, and if the engine is moving forward, we move forward. The Allegheny Conference, we have so many organizations, the governor trying to work to the foundations to stimulate and push the southwestern Pennsylvania economy. I'd hate to think where we might be without them, but the reality is that our growth, our population, our economic growth has been a laggard, and probably, I'd have to say, will be for the rest of the decade, unless, we start getting more people coming or retaining more students that come to our great universities, who usually end up taking a job someplace outside of Pittsburgh, if not outside the U.S. So I hate to end it on a little bit of a somber note, and I probably used up all of the time, but that's my story, and I'm sticking to it. I thank you for the invitation to be here. I can stick around for a few minutes if somebody does want to ask me a question. And if you want to ask me about the budget deficit, which is usually the first question, That's why I took up all this time, so you would not have time to ask me about what we're going to do about the budget deficit, because I don't have a friggin' idea what we're going to do about the budget deficit, because it's just going to get worse and worse and worse for the next couple of years, and we'll have to see how we handle it. Thank you.